The 11th of January 2021. In Grapevine, Texas, GameStop announces 3 new board members, including an activist investor named Ryan Cohen. Within hours, traders on Reddit begin treating this routine corporate announcement as evidence that a dying retailer might still have a future. GameStop operates thousands of physical video game stores, but digital downloads and online shopping have steadily weakened the business beneath its familiar name. Wall Street sees an outdated company moving toward extinction, while a growing community of individual investors sees a badly mispriced opportunity. The conflict begins with short selling, a market strategy that allows investors to profit when the price of a company falls. A short seller borrows a share, sells it immediately, and hopes to repurchase it later for less money before returning it. If the price falls, the trade produces a profit, but if the price rises, the potential loss has no fixed limit. GameStop attracts so many short sellers that reported short interest eventually reaches 122.97% of its publicly available shares. More than 100% is possible because one share can be purchased, lent again, sold again, and claimed by several investors. This creates a dangerous imbalance because many short sellers may eventually need to repurchase shares from the same limited supply. One investor studying this imbalance is Heath Gill, a former financial educator who publishes his GameStop research on social media. Gill appears online as Roaring Kitty and Deep Fucking Value, displaying a GameStop position that many viewers initially consider reckless. His argument is not that GameStop has become a thriving retailer, but that Wall Street has priced the company as though death is inevitable. Gill points toward GameStop's cash, recognizable brand, new console cycle, loyal customers, and remaining time to build a digital business. Then Ryan Cohen, the founder of online pet retailer Chewy, reveals a large investment and begins demanding a more aggressive transformation. Cohen gives the turnaround theory a credible corporate figure, while Gill gives ordinary traders a simple explanation of the underlying opportunity. Reddit users begin sharing research, screenshots, memes, call options, and increasingly large positions inside the Wall Street Bets community. The language looks chaotic and unserious, but the financial mechanism developing behind the jokes is powerful and potentially unstable. Every new buyer increases demand, every departing short seller must purchase shares, and some options activity can create additional institutional buying. These forces are different, but once they begin reinforcing one another, the price can rise faster than traditional risk models anticipate. On January 13, GameStop closes at $31.4. Gaining more than 57% during a single trading session. The sudden move carries the story beyond Reddit and attracts new buyers who had never previously examined GameStop's financial condition. Many short sellers still refuse to leave because the rising valuation appears to make their original argument even more convincing. Their confidence creates more fuel, since every short position that remains open represents a possible future purchase of GameStop shares. Andrew Left of Citron Research publicly predicts that the stock will return to $20 and describes the optimistic buyers as mistaken. Online traders interpret his prediction not as a warning, but as a challenge from the financial establishment they already distrust. By January 22, more than 197 million GameStop shares change hands in one day, several times the company's total issued shares. GameStop closes at $65.75, transforming a debate about retail stores into a confrontation over who will be forced to retreat first. Melvin Capital, founded by hedge fund manager Gabriel Plotkin, becomes the most visible institution betting against the company. Its exact GameStop loss is never publicly isolated, but the fund's portfolio begins suffering as several heavily shorted stocks rise together. On January 25, Citadel and Point72 agree to invest $2.75 billion in Melvin, as pressure builds across its positions. The investment looks less like a victory than emergency reinforcement for a fund that is rapidly losing control of its exposure. GameStop closes that day at $76.79 after briefly trading above $159, showing how violently the market has begun moving. On January 26, Elon Musk publishes the word GameStonk with a link to Wall Street Bets, exposing the rebellion to millions more people. GameStop closes at $147.98, while Melvin says it has exited its short position without revealing the amount lost. On January 27, The stock closes at $347.51 as American stock and options markets experience extraordinary trading volume. Brokerage accounts belonging to ordinary people are now connected to hedge funds, options dealers, market makers, clearinghouses, and automated collateral systems. Many retail traders believe that holding their shares will restrict supply and force desperate short sellers to accept almost any price. The later Securities and Exchange Commission review, however, finds that short covering represents only part of the buying during the surge. New demand and positive sentiment continue driving the price even after some short sellers have already begun closing their positions. This means the crowd has not merely triggered a mechanical short squeeze, because the crowd itself has become the dominant market force. The distinction is dangerous because a gain displayed inside a brokerage account becomes real only when another buyer accepts the trade. Before dawn on January 28, the hidden financial machinery supporting commission-free mobile trading suddenly enters the center of the story. American stock transactions require time to settle, and brokers must deposit collateral, while trades remain unfinished inside the clearing system. At 5:11 in the morning, Robinhood Securities receives notice that it faces a collateral deficit of approximately $3 billion. Robinhood does not have enough readily available cash to meet that demand, forcing the company to negotiate and urgently raise additional capital. The platform then restricts customers from opening new GameStop positions, allowing many users to sell while sharply limiting their ability to buy. GameStop reaches an intraday high of $483 before collapsing to $112.25 and then recovering part of the decline. To retail traders, the restriction looks like Wall Street changing the rules precisely when powerful institutions begin losing the contest. Robinhood says clearinghouse requirements caused the decision, and official investigations do not establish that Citadel ordered the company to restrict purchases. The controversy nevertheless exposes how every apparently simple trade depends on credit, collateral, securities lending, market makers, and settlement infrastructure. When extreme volatility reaches this hidden plumbing, the capacity of a broker can determine which investors are still permitted to act. GameStop closes at $325 on January 29, falls to $90 by February 2, and drops below $41 2 weeks later. Some early investors leave with extraordinary profits, while later buyers discover that a price can collapse long before a convincing story disappears. Short sellers also suffer billions in estimated losses, although no audited total captures every fund, hedge, option, and closing price involved. Melvin Capital loses 53% during January across its portfolio, even after receiving the $2.75 billion emergency investment. The fund never fully recovers, finishes 2021 down approximately 39%, and announces its closure the following year. GameStop uses the attention and elevated share price to raise capital, giving the supposedly dying company more time to rebuild itself. The institutions were not defeated by secret information, but by public data, concentrated risk, excessive confidence, and buyers capable of moving together. GameStop's price eventually fell, but the weakness exposed beneath Wall Street's machinery never disappeared.